Tariff uncertainty continues to loom over the markets. Well, the dollar has steadied today and European markets edged higher as investors digested fast-changing US tariff plans. All eyes in Europe will be on the ECB later this week, when the central bank has its latest say on interest rates. So how will all the tariff noise impact their decision? Well, Paul Hollingsworth is Head of Developed Market Economics at BNP Paribas. Paul, well, let's start with the ECB. What are you expecting on Thursday?
I think another cut is all but guaranteed here. Effectively, the disinflation process was already well on track, even before some of the volatility that we've seen in markets over the past couple of weeks. And now what you have is a scenario in which the euro is moving higher, energy prices are falling, you've seen a tightening of financial conditions, and on top of that, you have now exacerbated downside risks to growth. So that suggests to me the ECB still has more work to do in bringing rates lower.
Now, this morning we had some data out of Germany. Their ZEW economic sentiment slid from plus 51.6 in March to minus 14 in April. A Reuters poll had predicted a positive reading of 9.5. Why the huge plunge? Is this all tariff related?
What you've seen is effectively a shift from optimism in the wake of some of the fiscal policy announcements that this would be really boosting growth to now, as you say, much more of a focus on some of those more prescient near-term downside risks stemming from trade policy uncertainty. And of course, the ZEW measures investor sentiment, and so we are of course, seeing quite a strong link to the volatility we've seen in financial markets. But the way I interpret it is, yes, we've seen this shift on fiscal policy. That is good for the medium-term trajectory for Europe. But right now, there is a lot of concern, particularly amongst corporates, about that short-term hit from the imposition of tariffs from the US.
I mentioned the dollar earlier in the show, but if we look at the 10-year Treasury yields, they have bounced back today. But just how damaging do you think US trade policy could potentially be to the US Treasury market as a whole?
You've seen a lot of volatility, including in the Treasury market. I think the way to interpret that is we have seen effectively a tightening of financial conditions. And I think it's difficult to put the genie back in the bottle, if you like, which is that there is now so much uncertainty. And although we have seen some moderation from the Trump administration, including from last week, but also overnight some signs that there may be further moderation on autos, for example, that uncertainty, I think, is going to stay elevated. That is a persistent feature. And as I say, that is causing an additional tightening of financial conditions compared to where we were before.
You talk there about uncertainty. The markets want certainty. Do you think they'll get it anytime soon under this administration?
I think it's possible that uncertainty does come down from the especially elevated levels that we've seen over recent weeks. But I think it is likely to be a persistent feature of the economic environment that we live in for the next few years. Even if we get to the end of the 90 days and the US administration does not impose renewed tariffs, the reciprocal tariffs, it's always there as a threat, as a potential lingering threat there that affects sentiment and affects uncertainty. So I think some element of uncertainty is here to stay.
Well, early next month, the Fed meets as well. What do you expect from the US central bank?
The Fed has a really challenging trade-off here, and a much worse trade-off than other central banks like the ECB, in that it's trying to balance real downside risks to the economic outlook with upside risks to inflation. We've seen, for example, the University of Michigan inflation expectations data last week that was quite worrying. Of course, that is one survey, but other surveys, including the New York Fed, one is also showing some pickup in consumer inflation expectations. And so the Fed is really going to have to balance these two risks. And our view is that the Fed will stay on hold for the duration of this year as it tries to balance these two risks on the downside to growth and on the upside to inflation.
That was Paul Hollingsworth of BNP Paribas. And don't forget, you can watch more videos on Reuters.com.